Hi guys, introduce myself. My name is Arumeningsi from class 1 accounting P3. Today I will presentation on accounting cycle that are in accounting. Previously, what is the accounting? Accounting is a process that begins with recording, classifying, processing data, and recording transactions relate to finance so that the information can be used by someone who is an expert in their field and becomes material for making decisions. In accounting, there is such a thing as the accounting cycle. What is the accounting cycle? The accounting cycle is specifically defined as an iterative process of identifying, analyzing, and recording every accounting activity within a company. The cycle in accounting activities occurs within of 1 year. Number 1. Transaction identification. Accountants are tasked with identifying transactions so that they can be recorded accurately. Transactions that have a direct impact on changes in the company's financial condition and can be objectively valued should be recorded. Don't forget to include proof of the transaction to make the identification process easier, such as notes, invoice, or other valid evidence. Number 2. Transaction analysis. The double entry system is a common accounting recording system. Each accounting transaction must have an equal effect on the debit and credit position. So, the equation commonly used is asset amount liabilities plus equity. Number 3. Recording transaction to the journal. The financial journal is a chronological record during a period and contains various transactions that have occurred. Journaling is the term used for this process. You must record transactions sequentially according to the date. Accurately is required to that no missed transactions are recorded. Number 4. Post to general ledger. The next accounting cycle is to transfer or transaction in the ledger, which is a collection of accounting accounts containing information about asset record during one period. There is a certain code number that function to simplify the identification process, double check, or find references to transactions that have been recorded. Number 5. Making trial balance and adjusting journal. Trial balance contains a list of the balance of each ledger account over a certain period of time. The ledger balance are aggregate. They must be the same amount. When filing a transaction that has not been recorded or there is an error, the accountant must make the entry in an adjusting journal. making adjusting journal entries in classified as periodic in nature with a process similar to that of ordinary journaling. This step will make the result of the financial statement more actual. Number 6. Prepare adjust trial balance sheets and financial report. Adjust trial balance are prepared based on trial balance books and adjusting entries. Exciting balance are divided into groups of assets and liabilities and arranged so that they both have the same amount. If the balance of asset and liabilities is not the same, you cannot make financial reports. The new financial statement can be after the total balance and assets have the same amount. This report consists of several types including first, reports on changes in capital in order to see changes in capital that have occurred. Second, income statement provide an overview of how the company performing. Third, cash flow statement describes the relevant information on cash out and cash in for the current period. Fourth, balance sheet for calculation of flexibility, equity, and solvency. Number 7. Prepare a closing journal. This is the final accounting cycle, which is to prepare a closing journal. The preparation process is carried out at the end of the current accounting period. You do this by closing the profit and loss account or nominal account. You can do this by wiping out the value of the two accounts. Why is the necessary? Because you have to look at the flow from source after the current accounting period. Once the account is closed, you can use the closing journal to measure various activities carried out in a certain period. For the following periods, the closing entries will help research to accounting cycle from scratch. The last number 8, create a trial balance and turning journal optional. This step is optional. You can do it. It doesn't matter. The trial balance at this stage consists of the permanent account balance from the ledger account after making the closing journal. Making the trial balance after closing aims to ensure that the balance now is balanced and correct. Meanwhile, reversing journals have the goal of making the procedure for recording recurring transactions simpler. So, when you come across a similar transaction in the following period, you can record it quickly and accurately. A general turning entries are created at the beginning of the next accounting period. Simply make a reversing journal from the adjusting journal previously made. And then the accounting cycle includes a long process related to the company's financial activities, starting with recording transaction and analysis until the preparation of closing journals as a stage of preparation for the next accounting period activity. This stage is more than just the process of preparing financial statements. Okay, thank you for your attention. Good morning and bye bye.